Um, Good morning. My name is Tshireletso, but you can call me Tsire. I'll be your accounting educator for today. Um, the last time we had this session was Wednesday, and during Wednesday session we did question one of the exam that you wrote. So for this for this particular session, we are going to cover the second question. So can you please go get your exam and yeah, let's go through the second question, the second part of the exam. Okay, so I'll give you around a minute to go get it. Okay, I think that's about a minute. Before we start, I'd like to go through the approach again, um, just to illustrate how we should read the scenario, because like I said last time in last session, it's very important to read the scenario properly. So let's go through the approach. And the first one is perspective. So the first thing that you have to consider is perspective. So perspective is basically who you are. So what entity you are. In accounting, is very important to know what entity you are, because they can give you like many entities. So you have to firstly, like, you have to know what entity you are, and this is going to be more relevant when you're doing groups. So in next semester, this is going to be more relevant next semester, so to know who you are. And then the second point for perspective is date. So you have to know what is the reporting period. So your reporting period, the year of assessment, right? You have to know your year of assessment. That's very important. And what's also important about the date is the way in which you read the dates in the scenario. Always read the dates in reference or with reference to the reporting period, because reading it like that will give you more information than just reading the date. So just saying maybe 15 December or 31 December 2021, that doesn't give you information. However, if you um, say the date with reference to the reporting period, then you'd have more information about what happened, right? And then now that you know the date, okay, the standards and legislations that are applicable, obviously for this one, for accounting, it will always be IFRS standards or the conceptual framework. So those are the two standards that we use for accounting. Today it's IFRS or the conceptual framework. And basically in accounting, they start with the standards first. So the standards take precedence. So you'll see in all questions will always start with standards, and they will always start with standards. And I think because you are on a third year level, because like I was doing third year even last year, on a third year level, they don't really ask much about conceptual framework. So I won't touch on it now. So they ask more on standards, like how to apply those standards. So I'm just gonna go through how to apply those standards. So now that you have the perspective, right? You know the date, you know who you are, right? When you're reading the scenario, they're gonna be triggers, and I'm gonna explain what is a trigger. So when you read a sentence, they will tell you maybe that this event happened, right? So this happened, and if it happened this year, you know that you have to basically record that event happening this year, right? That's why it was important to know the date. If that event happened this year, then you know that you have to record it. If it happened let's say it happened some other, maybe last year, it happened last year, then you know that you have to look at the requirement in the standard, right, for subsequent measurement of that particular event, right? So it's very important to also know your triggers. Or maybe if in the test they're telling you that you are given new information about maybe an asset or something, or the management has changed their intention or something like that with an asset or the liability, then this is where the new information gets in. So this trigger will help you basically already compile standards that you have to use, because it's important to know that with like when you're using IFRS, you're using standards, right? So it's important to know what standard you're in, because once you know what standard you're in, then it's easier for that, because you're only going to apply the rules in that standard. Now, what I've seen, what I've seen like in most question papers, and what I've seen like most learners really struggle with is actually identifying which standard it is. So the identification part, the scope part, and that's very important to know what standard you are in. It's not enough to know maybe that this standard may apply or that standard may apply. You have to know exactly what standard you're working in, so that you know that the rules pertaining to that standard they are applying to this particular scenario. And then after you know what standard that thing applies to, then you can start thinking about the recognition. When should I recognize it, or whether you should recognize it or not, right? Because it's not enough to know what standard that thing is in. You have to know when you have to actually recognize that thing. So that the recognition criteria of that particular item, right? When. And the last thing is measurement. So we're gonna read the question right now. As we are reading the question, I'm going to apply the approach and show you how to derive a lot of information from a question. So let's start. Let's go to question 2. So question 2, it says Abacus International is a South African company. So Abacus, do you see that's the first thing? Who are we? The person is Abacus, right? Okay, before we do that, let's this is also exam technique. Ne? So for exam technique, the first thing to have, may you please have basically 2 pages open, ne? And then you're gonna write your solutions in one page and your calculation on another page. Please don't make the mistake of not writing what you think. Think on the paper, and then if you deem that thing as a mistake, then cancel it out. They're not really worried about like how neat your paper looks. So write it down and then cancel it out if you don't want it there. But at least it's there. Ne? So when you're reading a question, so I'm going to start with the required. So let's go to the required. The required for question 2 says prepare an extract of Abacus Limited's financial statement of financial position. So the SFP, right? Do you see Abacus? That's the person, right? That you that's the company. That's who we are. So Abacus, and the date. They're telling us the date. They said the year of assessment is the 31st of March 2022, right? So 31st of March 2022. So when did it start? It started on the 1st of April 2021, right? So now we know our year of assessment. Can continue. It says they want this this extract in relation to the head office building, warehousing building, and construction center. You will see it's basically the whole scenario of question 2. They want you to prepare an extract of the statement for the whole so for that whole question, right? Then let's look at the notes. The note says show all workings as marks are awarded for this. Do you see that first point? That's very important. Like I said, it's very important to have that calculation sheet. You will see, I can assure you, most people who also like didn't pass like the exam, or who are struggling with accounting, is because of this. They are not writing down their calculations. So write down your calculations. That's very important. I'll move on to the next one. Then the next point says calculate the deferred tax balance in respect of the affected asset using the assets and liabilities method. So what they want to see is the assets and liabilities method when you're calculating the deferred tax balance, right? Then they said you are not required to include the loan from Absa Bank in the extract of the SFP. So you're not in, so which means in the question there's a loan, just write that as a point somewhere, that loan you don't need to to consider in that SFP, right? And then it says round all amounts to the nearest rand. So all amounts have to be rounded to the nearest rand, and they said percentages have to be rounded off to the nearest so to 4 decimal places, right? And they told us that no disclosure is required and no comparatives are required. So do you see that in this question, they didn't say anything about dates and they didn't say anything about general narrations, right? So you have to put in the dates and general narrations in your journal entries because they didn't specify that they don't want them. They just said no disclosure and no comparative amounts, right? So what they mean by comparative amounts, I'm sure you remember when you're doing IS1, so presentation of financial statements, when you're presenting financial statements, again, this is a presentation. So you're preparing when you're presenting financial statements to users, you have to show them comparative amounts, right? That's why they specifically told you that they don't want comparative figures. Okay. Now we can start with the question. Now that we know the required, so we know that the required says it wants an extract of the statement of financial position, right? Now with accounting, do you see where so do you see what exactly they want here? They want this part, the measurement part. That's what they are focused on this question. Do you see this part? They're not really focused on scope. Scope, basically, you will see that question, it will say discuss whether or not this thing is in the scope. So this thing is an impairment, this thing is an asset. So you're discussing whether the thing it is it. So in this question, that's not what they're asking. They're asking the implication. So the measurement part, right? They're asking the implication, the measurement part, right? Now, if they were asking this, the scope, then you are just gonna use your identification rules, right? Then in most cases, they ask the scope and the recognition criteria at the same time. So now, so they ask you something like identify and determine when this thing should be recognized, right? So this scope and identification part, so this part of implication and the scope, in most cases, they are together when you're doing discussion questions. However, if it's a question that requires you to calculate, so it doesn't matter. So it requires you to calculate, then the implication, do you see that it's on measurement, right? And if a question requires you to calculate in any way, so they don't say discuss, or even if they say discuss, they are saying discuss the implication, not the scope. So what do you do with that amount? The first thing you do, the first thing is, if it's a calculation, do you see like here, we are preparing the financial statement, so we are going to calculate. So we are dealing with measurement here. So if it's that, the first thing you do, it doesn't matter what you're doing, prepare journal entries, because journal entries in accounting will guide you into writing the correct amount. So prepare journal entries first, and then aggregate those journal entries and put them in the statement, right? That will be better. Otherwise, just writing those numbers, like maybe you have maybe that PPE, just writing that you have to add this and subtract this, that's confusing. But at least if you go journal entries, you do your journal entries. After you do your journal entries, don't forget the question didn't say journal entries. You aggregate those amounts, so you show them that way. So you just add them, show them that you add them. I'll show you how what I mean, and then give that statement. I'm telling you, that way will be better, and you'll get more marks that way, because basically, like I said, accounting is a story. It has a beginning and it has an end, right? So you have to follow that process, and journal entries help you with that story. Yeah. So let's go to the question. So it says Abacus International Limited is a South African company with a 31 March financial year end. So we already know that we are Abacus, and we already know the financial year end. Then Abacus is in the property. Abacus is in the property development. Is in the business of property development, right? Okay, that's not really relevant for accounting. Then some properties are sold when development is completed. So do you see that some of the properties must be classified as inventory because they are sold immediately after development is complete. So some of their property is going to be inventory, and then others are rented out under short-term leases to domestic companies. So they're telling us that the other ones most probably are going to use IS 40, right? Investment properties, because what does IS 40 say about investment properties? Investment property is a tangible asset. So right, it's a tangible asset, right? That you're gonna get like rental amounts from that capital asset or capital appreciation. So here they're talking about rental under short-term leases. So most probably IS investment property applies there. We can continue. It says during the 2021 financial year, Abacus acquired a plot of land for development in Midrand, Gauteng. Right. So last year, like I told you, when you see dates, make reference, refer those dates to the reporting period. So what is the reporting period? It's 2022, right? So you know that during 2021, what they actually mean is last year, that's what they are saying. Last year, Abacus acquired a plot of land. That's what I meant when I say give those dates meaning. So last year, Abacus acquired a plot of land for development in Midrand, Gauteng. They paid 7.5 million for the land. Do you see that they bought land and they told us that that's excluding VAT? Okay. Last year they bought this land and they said the land was subdivided into 3 equal size lots. So for that one, in order to see it properly, I drew a diagram illustrating this plot of land. So we know it's divided into 3 portions. And then what they say, that they said these lots can be sold separately. Okay. And they said the cost of the land was allocated equally between the 3 lots, right? The 3 lots. Now, it's important also to remember that you are doing the statement of financial position, right? So you want the balance of items. So the one thing that you shouldn't forget here is that in the statement, they already told you something to do with land, right? Do not forget the land. So the first thing you have is the balance of land. That's the balance you have so far. And that balance is 7.5 million, right? That's the balance you have so far. Just keep it with you. This is the balance you have. So, or this is one thing that I forgot to note. So when you are dealing with statements, so when you're doing the statement of profit and loss, it doesn't really matter what happened last year in the statement of profit and loss, unless that that particular item affects the profit or loss, right? However, for the statement of financial position, this is a balance that we are working with. Do you see? These are balances. So which means what happened last year, that the balance of last year is important. So it's important to know that as we go down, when you see an item, just try to find its balance for the beginning of the year. So the balance of that particular item at the beginning of the year. So the balance at 1, so the balance on 1 April 2021, right? And I know that the land is 7.5 million because they haven't said anything about the land, and we know that land is not depreciated unless they're gonna tell us something about a revaluation. That's the balance for land, right? We can continue. It says Abacus developed 1 lot for its own use. So what they say, so one of these lots they developed for their own use, right? So one of these lots, and then they said to construct a new head office building on, right? So I don't know, I think last time I did explain what owner occupied means, Mara. I will do it again. So the problem between IFRS 16, whether to use IFRS 16 PPE or IS 40 investment property, the problem lies in like the owner occupied, right? Owner occupied, meaning like, is it used by the owner? So do you see that the Abacus is going to use that that particular head office, that particular building as a head office, right? So they are using it. So it's owner occupied. So owner occupied is when you are using it. Now think about it. For investment property, you're not really using the okay, I'll go back to them. But for investment property, you're not really using that property. It's used by another person, so another entity or another person. So that's why we don't apply IFRS 16, because IFRS 16 is only owner occupied. So we as the business have to use that particular asset. Let me give you another example. Let's say between a hotel and like a normal like so you're renting normal flats. Ne? Do you see that for hotel, you are providing more services? Like in that hotel, you're not only providing rent there, you are giving them food, comfort. Like there's just a lot that you're doing there. So you are occupied. That's owner occupied. So it's in the level of time. So time that you invest, that the time that the entity invests in that particular tangible asset will determine whether you're using IFRS 16 or IAS 40. If you see that the entity is not really spending time there, so that they are, like for instance, if you are just renting flats, you are only responsible for just certain services, make sure that they are protected, maintenance there, but you are not really involved in, like you're not really directly really involved in that business. And because of that, that's investment property. Ne? So investment property is not owner occupied. That's why investment property, they said, it's for when you're earning rentals, right? So rentals only, or for capital appreciation. So you are not occupying that particular property. So what does it mean? It means that these two, so the land here, the plot of land here, right? Let's continue. So we know this one is IS 16. But let's continue. It says the last two lots had warehouses constructed on the lots, right? And they said um, to be rented out under lease agreement. So do you see that this is a lease? So which means IS 40 is going to apply to these two lots, right? Because they just said rental, right? So it's IS 40 for this one. So it's investment properties. So this one plot of land is PPE. This one is investment property, right? Then they said the development of the land commenced during the 2021 financial year, which also means so the development of the plot of land commenced last year. So it started last year. And all properties are considered to be qualifying assets. Now, for okay, qualifying assets in terms of IS 23 borrowing costs. Now, let me go back to IS 23. Before you can use IS 23, that asset must be a qualifying asset, right? And there are stipulations in the standards that guide you so as to what is a qualifying asset. So please just have a look at like that part for the qualifying assets. So what's the scope for qualifying assets? Because maybe in the next they might ask you whether the thing is a qualifying asset or not, right? In a test. So just know basically what a qualifying asset is. And then they said in terms of IS 23 borrowing costs. So what happens when you have a qualifying asset, right? So it meets the definition of a qualifying asset, right? And what happens is you take out a loan, right? You take out a loan to construct that asset, because a qualifying asset, you'll see, firstly, it has to be an asset in construction, right? So you take out a loan to construct that asset, right? What does the standard IS 23 says for borrowing costs? It says the interest on the loan, that interest on that loan, the interest on that loan, you are going to capitalize to the asset, right? You're going to capitalize to the asset. That's what it means. And just this is for future reference. You'll see it's not here in this question, but in most cases they show so for this type of question they have this loan, so you're going to have this loan percentage, right? So this loan interest, I mean, yeah, interest on loan. And then what they do is the business, because they don't use all the funds, like all the funds that they receive from the loan immediately, right? Because they don't, in most cases they're going to put those funds in a money market, or sometimes they call it a surplus fund account. So those surplus funds, they're going to put them in a money market account. So that's basically a small savings account that gives you like small interest, right? Because it's better to put it in that account while you're still waiting, like at least to get some interest. If that's the case, now when that's the case, that interest that you get from the money market or the surplus funds account, do not forget that you have to also capitalize to the asset. And what I mean is reduce the asset with that interest, right? Because for borrowing costs normally, sorry, for borrowing costs normally, what are you going to do for borrowing cost? Normally, what do you do for borrowing cost normally? You say you say PPE you credit, right? And then you debit the loan, right? Why do you credit PPE? Is because you're capitalizing that interest to the asset, right? Do you see that normally for a loan, you're just going to say loan you credit, and then the interest on loan you debit. But instead of the interest on loan, it's the PPE. That's how it's capitalized. And then if you have like I said, if you have funds in that money market or surplus fund account, what happens is that interest that you receive from that account, you have to reduce the PPE with that amount. So normally the interest, when you receive interest like interest income, what do you do normally? You say that basically that interest account, right? That savings account you debit, right? You debit that account, that money market account, and then you credit the income, the interest income, right? But in this case, like I said, that interest has to be capitalized to the asset, so it has to reduce the asset to that amount. So what you're gonna do is you're still gonna credit the money market account, so that fund account. However, what you're gonna debit is the PPE. So the PPE is going to be reduced by that amount. Yeah. That's the main principle basically for borrowing costs. So as we move on, I'm gonna apply now this principle. So let's move on. It says the head office building. Now, what did we say the head office building is? We said it's PPE because IS 16 applies to it, right? Okay. So let's continue. So it says Abacus took out a loan of 10 million from Absa Bank on 1 April 2001. So it took out the loan at the beginning of the year. Like I said, every time you read dates, make sure you reference them to the current year of assessment. So the reporting period, this reporting period, do you see that it's the 1st of April 2021, right? I think they made a mistake on your question paper, but they did fix it for you. So it's 1 April 2021, and specifically for the construction of the head office building. Do you see that this loan they took it specifically for the construction of the head office building? This is very important. Like, this is a very important concept for borrowing cost. Even if let's say you are building an asset, then you take out a loan separately, and that loan is not specifically to construct that asset, then you will not capitalize those borrowing costs because that loan was not taken out specifically for the asset. And what do I mean when I say the loan was taken out specifically for the asset? It means that the amount that you're going to use from the loan, you're going to use to fund the construction of the asset. So that money has to fund the construction of the asset. That's why it's capitalized. That's why the interest is capitalized, because that money is the one that's funding the construction. And this is also another rule. They didn't also put it here, but also for borrowing costs, they can make it difficult also like this. So what happens is, during the period, let's say maybe they say, in some cases, they will tell you that they paused construction. So construction was paused. During that period of the post construction, that interest won't be capitalized to the asset. It will just be interest normal. So as long as they are constructing, that's when you capitalize that interest. You capitalize that interest while they are constructing. So what happens, even if they are finished constructing, you're gonna finish, you're gonna stop capitalizing. So when they finish constructing, stop capitalizing, that liability is a normal liability. And then there's another principle, so you can continue. It says the loan bears an interest. Okay, so let's look at the first thing. They said it took out a loan of 10 million from Absa Bank, right? So we have two things here. That loan was taken out for construction, so it's IS 23 borrowing cost. Like I said, we have to look at our scope. So IS 23 borrowing costs, we know it applies. However, IS 23 is a standard that I like to call basically an underlying standard. So there are two types of standards. There are main standards and there are underlying standards. So underlying standards are standards that depend on other standards. So the existence of that standard depends on another standard, right? Like for instance, borrowing cost, it will never exist borrowing cost without another standard. So you have to use the borrowing cost with another standard. They don't exist like alone that standard. Also the one for deferred tax, you see, you need other standards for it to work first. Then things like also groups, things like IFRS 13, the fair value measurement standard. All those standards, they require the existence of like a standard, right? Now, in this case, do you see what happens? They said Abacus took out a loan. Ne? Now, what is a loan? A loan is a financial asset, right? A loan is it's a financial asset, right? Not a financial asset, I mean it's a financial instrument. So it's a financial liability. And what standard applies to it? It's IFRS, um, it's IFRS, it's IFRS 9. That's where you get it. So it's IFRS 9. Ne? Now, do you see that we are still dealing with the loan? Ne? Don't think about the PPE now. Let's deal with the loan first. Ne? That's why I'm saying it's important to know what standard you're working with. You'll see with borrowing cost, you're going to include it while you're doing another standard, but you cannot do IFRS 9 and IFRS 16 at the same time. That's where you get confused. Ne? So let's start with what they gave us first, the loan. Now, do you remember at the when you started the question, they said you don't need to give the loan balance, right? Even if they say you don't need to give the loan balance, I suggest you do the general entries anyway, right? It will help you to have like a sequence. It will help you to have that story, and you will see discrepancies faster if you working like in a story format. So let's continue. We know that IFRS 9 is applicable because this is a loan and this is a financial liability, right? And this is a loan, so normal amortized cost. So they tell us that the loan bears an interest rate and bears interest at an effective rate of 10.4% per annum, right? So that's the interest, that's the I. And then the loan is repayable in 10 equal annual installments, right? So we already know that this thing is 10 years and the first installment falls due on 1 April. I assume that they meant 1 April 2022. I assume that. So this is based on the assumption that that's 1 April 2022. That would mean that they basically have this loan for 10 years. So now you have to just put it like in, so they have this loan for 10 years, right? So what happens then? When did they get the loan? They got it this year, right? So we have to do the general entries for this year. So let's look at the loan. So what general entry are we going to process when we receive this loan initially? We are going to say bank we debit, we right, and loan we credit, right, with the 10 million because we received 10 million. That's the first general entry, right? And then think about, like, that's what I'm saying. This is a process. This is a story. Think about a process of a loan, right? A loan, you record it firstly initially when it comes, right? You also record, you also do something on the loan when firstly there's interest on the loan. You know that there's interest on the loan, and basically you are paying out the loan or you're increasing the loan. So if something happens, so if the terms and conditions change, so you pay the loan, or yeah, you pay the loan. So it's either you pay the loan, or the third thing is the terms and conditions change. So you get a higher loan, or the interest rate changes. Those are the three things that can happen to a loan, right? So now this is how you account for it. Interest. So interest, the general entries for interest, and this is also like the principle for loans and savings, like in general. So for financial instruments for IFRS 9. So what basically happens is that interest, you only account for it like at certain points. So you only account for it, number one, if you are at the end of the year, then you can account for interest. Or number two, when there's payment. So if there are payments to the loan, then you have to account for interest first and then account for the payment. And then if there's any change in like the conditions of the loan, so the loan is increased, or maybe you're giving a different percentage, or you're required to settle the loan, maybe they change the number of years. Do you see that they change the terms of the contract? When they do that, you firstly calculate the interest for that period, and then after then you change the conditions for the loan and then continue, right? So that's the only thing that happens, right? So we have to look for those things. So as you can see, they didn't really say anything else about the loan. Do you see? So we are going to assume that the first payment, because the first payment occurs next year, There's no payment this year. So the only thing you're going to record is the interest for this year, the interest on the loan. Now, do not forget, this loan was taken out for what? It was taken out for specifically for construction of the head office building, right? So we know that IS-23 borrowing costs apply to it. So what are we going to do? We are going to calculate interest normally, like normal interest. So you're going to calculate normal interest normally using the rules in IFRS 9. So you're going to calculate normally by saying, firstly, the present value is 10 million, right? The N is 10, and then you're going to say the I is 10.4, right? And then the future value is obviously 0. The payments, you don't know the payments, that's the part you don't know. And then the last input, the period, so it's per year, so it's per year. And just to remind you, you see those 6 inputs that I've just like said, for so every time you are doing a calculation that needs those inputs, write all of them down. So where value, like there is no amount, just put it 0 there. Like future value, do you see that for a loan value there is no future value unless they tell us that you are paying a balloon payment, but there's no future value here. So in most cases, most people don't write that FV part. They just leave it alone. It is right, you can leave it, but I'm telling you, this exam technique, write all the 6 inputs down. It helps a lot, especially not to forget an input, because I have the, so even I have the tendency to forget inputs, right? That's why I suggest this, that you just write all 6, and then where there is no amount, you put a 0 there. Yeah? Then if you put that in your financial calculator, right, you'll get an interest of 1,040,000, right? That's the interest for the year. However, before we record that interest, we have to firstly check that that interest did, like, was the construction for the whole year, because we want to capitalize this amount, right? This is the interest amount that we want to capitalize. But we have to ask ourselves one question: that is that amount like for the, like, was the construction for the entire year? Did the construction take place for the entire year? And they tell us here that if you can move a bit down, that the construction of the building was completed 28 February 2022, right? So that's when it was completed. It was completed February. Do you see it was completed 11 months into the financial year, right? 1 month before the end of the financial year, right? Like I said, dates, read them with reference to the reporting periods, right? So it's 1 month before the end of the financial year, right? That's when they finish construction. So do you see that 1,040,000, right? That we calculated, right? That 1,040,000 we calculated, that's for the whole year, right? And it will be incorrect to capitalize the entire amount of that interest to the PPE now. Why? Because construction ended before the end of the year. So not that entire amount must be capitalized to PPE. So what must happen? You must take that 1,040,000 and multiply it with what? 11 over 12, because it's for 11 months, right? 11 over 12, right? Because the construction was for 11 months into the year, right? And the amount you get is 953,333,333. Now, remember they said round off to the nearest amount. So it's 953,333. That's the amount. And then what you're gonna do with that amount is you're gonna firstly say PPE you debit because you are capitalizing to PPE, and then the loan you credit with that amount, right? And then don't forget that although we are going to capitalize only 11 out of 12 months, right? Do not forget that the loan contract is different, is way different from the construction, right? So the people from that, so the people from Absa Bank will still charge you that interest for that month, right? So do not forget to say that 1,040,000, right, minus that 953 to get the interest for that last month, right? And you must record that interest for that last month by saying finance cost, you debit, right? The interest on that loan you debit, so finance cost, and then you credit the loan, right? You credit the loan, the financial liability, right? That's what you do for that loan, right? And it ties on to that principle of when do you capitalize, when do you not capitalize the borrowing costs. Ne? Then let's look and see. Let's look and see. I think yes, for the loan we are done, right? Because the loan we did say for the loan we did say that it's only the interest that we have to worry about. Do you see that we are done with the loan? And now we can move on to something else, right? Now you can move on to the next point. It says during the 2022 financial year. So what I mean is, you see in a test, like if you find yourself like thinking too much, and you don't have like really a process to follow, then like it's better like to find a question where you have a process to follow, because most probably you're gonna get that thing wrong anyway. So have these processes like in mind while you're doing this thing. So let's continue. So it says during the 2022 financial year, so during this year, what happened? Abacus incurred the following costs funded by the loan and other cash available resources, right? So they told us that it's funded by the loan and other available cash resources. That means that it's also funded by whatever was in the bank at that point. So not only the loan, but whatever was in the bank, because you'll see these amounts when you add them up, you get 12 million, right? Which is more than the loan. So it makes sense that they had to include even that part that um, it's also funded by other cash available resources. But that doesn't really matter. The general entry will still be the same. You're still gonna take all of those amounts and capitalize them to the asset, right? So you're going to say 2 million plus 7 million plus 3 million equals to 12 million. So PPE you're gonna debit, and then you credit bank because you used your cash available resources. So you credit bank, or you credit cash and cash equivalents, but bank will still work. So you credit bank, and then with that 12 million. So that's the first general entry, right? And then don't forget that general entry for capitalizing the PPE, right? Where are we now? We are in IAS 16. So we are done with IFRS 9. We are in IAS 16 now, PPE, right? Because we're capitalizing to PPE. And let's now tell the story of PPE. So firstly, now that we know it's in PPE, the first thing is, you know, that when you have this asset, you have to firstly recognize it, right? Recognize all the costs that are attributable to the asset. We did do that, right? And then after, what do we do to the property? Is either two things happen, right? We use the property, then we incur depreciation for using that property, right? Or maybe you sell that property, or that property is damaged, but that's something to do with impairments and disposals, right? That's not within the standard. The standard deals with so that it so the I mean when it gets damaged, that's IS 36, that's impairment. So the standard doesn't deal with that. However, it also deals with disposal. So let's go through the story again. When you get an asset, if IS 16 asset, what do? You record all the costs attributable to the asset. That's why we even included this finance cost, like this borrowing cost. That's why, because it's a cost attributable to the asset, right? Because you took out that loan for the asset, so you paid the interest. Why did you pay the interest? For that asset. So we did calculate all the costs, the cost to bring in the asset in that condition and location that management intended, right? Now we are done with the initial part of it. Now, subsequently, what happens? That asset, what's going to happen? You're going to incur depreciation, right? Because it's IS 16 as you use it, right? Because it's owner occupied, right? So that's the thing that you can record, or when it's disposed. Now, they didn't talk about anything about disposals here, right? So the only thing that we are going to consider is the depreciation. So that's what I mean when I say the story. Know the story of the standard first before you attempt the question. Because if you don't know the story of the standard first, then you won't be able to attempt the question. Because now attempting the question is easy because you're just following the story. We know that the only thing that we have to consider now is depreciation. You see, the only thing we have to consider now is depreciation. So all we are going to do is what? We are going to take the cost of the PPE right now. So you're going to add all of those PPE costs. So you'll see the general entries that you've done so far. Just add all of the PPE amounts, right? And the amount we get is 12 12,953,333, right? That's the total cost of the asset, right? And what do we do? They said owner occupied properties accounted for using the cost model. So it's using the cost model as per IS 16 property, plant and equipment. Do you see? We're right by saying IS 16 property, plant and equipment. This is very important. You see, once you know your standards, you are already like on a fast track to passing, because the main thing is people get confused with standards because you have to deal with the standard. So all of those standards that I called main standards, not underlying standards, those main standards, you have to deal with them alone. Do you see that the IFRS 9, I'm not doing it at the same time as I'm doing IFRS 16 or IS 40, because all of these are main standards, right? So I can't do this and this and this, right? So focus on one thing, know its story, apply its story, and then go to the next standard, right? So this one, they say the residual value is 0, so you won't minus anything. Then all you're gonna do is you're gonna take that amount, that 12,953,000, and divide it by 25 years, right? Then that's the depreciation for the year. But don't forget, this building was brought into use only 1 month before the reporting date, right? So you must also multiply by 1 month out of 12 months, right? So one out of 12. Yeah, and then you get your depreciation expense, and that's you get your depreciation expense, that's 43,178. Don't forget to round up, because they said yeah, round to the nearest so amount, because that was the requirement. Yeah. And then, do you see that now that you knew that it dealt with IFRS 9 and IFRS 16, you know that this first part, because the office building is IFRS 16, you're actually done with that first part. But however, this is something that you also need to note down in your head. Every time you are done with the general entry, so you are done with general entries, you're okay with general entries, do not forget the general entries for deferred tax. Deferred tax is there every time. So do not forget the general entries for, do not forget the general entries for deferred tax. Do not forget the general entries for deferred tax. Now, they told us that we have to do the deferred tax using the assets and liabilities method, right? So the first thing you're gonna do is you're gonna get the carrying amount of the carrying amount of the asset, right? By adding all of those PPE amounts and then subtracting the depreciation, right? And then you get 12,910,155. So 12,910,155, that's the carrying amount. And then we go to the tax base. So the tax base, they're telling us that they it's depreciated on 5% per annum on buildings, right? And it's 5%. So you're gonna take that amount, that cost that we calculated, multiply by the 5% on the building. However, please please note that I don't have the memo right now. So I want you to hold off a bit on that 5%. I'll get back to you on that 5%. The reason is, I have to still check in the legislation for tax whether borrowing costs are capitalized on the tax side, because we know that they are capitalized for accounting side, but I have to check for tax side. But for now, I'm assuming that they are capitalized. So you're just gonna use that amount for PPE and then multiply it with 5%. That gives you your allowance for that year. You minus the allowance for that year, you get your tax base, right? So then you're gonna say carrying amount minus tax base. It gives us a positive amount of 604,489, right? That's the temporary difference, right? And that's a positive amount. So that means that there's a deferred tax liability, Yeah. And then yeah, we can move on. However, I'll explain an easier way to do deferred tax in the next part of the question. So can we let's page to the next part. So number 2, right? Number 2, it says warehouse facilities. Now, do you see that what did we deal with so far? Don't forget that deferred tax is part of IS 12, the standard for income tax. So we did that deferred tax IS 12. Like I said, do you see that deferred tax is an underlying standard because we need the carrying amount? You need to calculate the carrying amount using other standards, right? So all of these ones, so you see these ones that I have a tick, these ones are the main standards, and then that one is an underlying standard. Don't forget, main standards you always do alone. So always consider main standards alone, and then underlying standards you're gonna consider with other standards, right? Now we can continue. It says the warehouse facilities were developed from available cash resources. Do you see? It says firstly from available cash resources, so which means it was developed using the amount from land. So there are no accruals here. They didn't like have any payables. They used their cash. Then they said direct. So where are we now? Do you see we are here IS 40, right? Because they said they are for rentals, and we said these warehouses are for rentals. So we know IS 40. They said direct development costs of 15 million, excluding VAT, in total were incurred to construct the 2 warehouses, right? So firstly, what are we gonna do at this date, right? They said so what are we going to do at this date? We are going to say investment property we debit, right? Because this is investment property, and then we credit bank with that 15 million. That's the first general entry. We credit bank with that 15 million, and then we can continue. The warehouse construction was completed on 1 March, so 2022. That's 1 year before, so 1 year before the reporting date, the end of the reporting date, right? And immediately rented out to Big Pharma Limited under a 2-year lease contract, right? Now, do you see they didn't tell us anything about the lease contract? So just forget about the lease contract for now. Let's look at this investment property. It said on 31st of March, so the last day of the financial period, an independent valuator estimated the value of the combined properties to be the first point is 26 million excluding VAT, based on observable prices for similar properties in Midrand. So you know that if it's based on similar, it's based on observable, that's level 1 of the hierarchy. Then they say of which 6 million, you see 6 million is in respect of the land, right? The market has been very active over the past year, right? Then they say, and 28 million excluding VAT using the discounted cash flow model, right? That's level 2, right? Based on management estimates of future rental income, right? So, okay, and then they tell us that investment property is accounted for using the fair value model as per IS 40. Now, you know that investment property can be accounted for using the cost or the fair value model. So before you jump to say that investment properties is fair value model, just do not forget to look at what model that entity is specifically using. Some entities do use the cost. And also for PPE, do not forget that the cost model is not the only model. There's also the diminishing balance model. And that other one, I forgot that other one, but it's based on activity, basically. Yeah, don't forget that what I'm saying is don't forget that there's more than one model for these things, right? However, if you're not given the model, use the ones that they normally use. So for investment property, fair value, but they will give you the models. They have to give you the models. And then let's look at this one. So for fair value measurement, the first thing to do is you have to consider whether this thing is a basically a non-financial asset, right? Yeah, a non-financial asset, and it is a non-financial asset because a financial asset is basically if you have the right to receive cash from an house or something of a similar nature. So here, this is a non-financial asset because it's a real asset, it's a tangible asset, right? So according to IFRS 13, I'm sure you already did the fair value model, and it's also an underlying standard. So according to the fair value model, do you see why we also call it an underlying standard? Because why? It's used, do you see it's used in IS 40? Do you see we are still in IS 40, but we are using this IFRS 13? So it's an underlying standard we use with IS 40, so it's okay, we can use it. So what's happening? It says what does that standard say? It says for a non-financial asset, you have to firstly look at what its use. You have to check the highest and best use of that particular particular asset, non-financial asset, right? Do you see that in this case, they didn't tell us anything about how the asset is being used in both of these instances, right? If they gave you two instances where the asset is used differently, né, listen, it doesn't matter whether USD entity, like it doesn't matter what USD entity are using that asset for, né? Like you are gonna just, if they give it, you're given uses, you're gonna take the highest and best use, né? Highest and best use. And then for the next part, so for the next part, now that you are done, we know that you are not really considering the use. That's where you consider the hierarchy, né? The level 1, 2, 3. So the hierarchy says you use the highest level. So the highest level is level 1. So you're gonna use that 26 million. That's your fair value. So what's going to be your general entry? The general entry that you process, it's going to be investment property debit, right, and credit fair value gain with an amount of 11 million. Yeah, 11 million. That's the part for the investment property. And then they tell us that SARS grants and unapportioned allowances of 5% per annum on investment property. And don't forget, they said use the assets and liabilities method, right? So you're going to start with the carrying value of the investment property, which is 26 million, right, at this point. And then now, before we start with the 26 million, how are we measuring that investment property? We are measuring it using the fair value model, right? This is not the cost model. So if you're using the fair value model, what you have to remember is that initial cost of the asset, right? You have to now split it with the fair value. So what are you going to write in your table? This is how your table is going to look. Basically your I mean your the asset and liabilities method is done on the table. So this is how it's going to look. You're going to have I won't draw the full table. I just want to illustrate this point. So it's the carrying amount here, and then here we have the text base, right? We have the text base. So what's going to happen? Like I said, if it's not like on cost, right, you're going to split this thing, going to split. So it's the 15 million, the initial cost that you bought the asset for, right? Because don't forget the current carrying amount is 21 million. Then it's 15 million. Then you put that 11 million here. So let's say it was a fair value loss. You're gonna put that loss also here, but in brackets. Né? However, don't forget, if it's fair value model, you have to do this. You have to split the cost from the gain. Why? Because although tax gives you unapportioned allowances of 5%, what is deferred tax? Deferred tax is temporary differences. So if you can get the truth, that deferred tax is temporary differences. So as long as the difference is temporary, that's when we can actually account for something. Now, this 15,000, this 15,000, you see this 15,000, accounting will never depreciate this amount. You see, although tax says it's giving allowances, right, like normal allowances, accounting will never depreciate it because it's using the fair value model, right? This 15,000, this portion for the 15,000, accounting will never depreciate it. So what does it mean? It means that tax and accounting amount will never be the same for this 15 million, right? That means that it is a permanent difference for this 15,000 amount. So a permanent difference for this amount, right? So what are you gonna do? You can calculate the tax base, right, by saying 5% of this 15 million. We can calculate the tax base, but it doesn't really matter. So whatever amount you calculate, so calculate an amount here. However, just know that here, what you're going to write here, this thing gives you like a permanent difference every time. So what you're going to write here is simple. You're just going to write IRE, which means initial recognition exemption, right? IRE, and that's what that thing basically means. That's because this amount will never be the same as that amount, right? Now, let's look at the 11,000, the 11 million, I mean. Now, you know that for the 11 million, SARS gives, do you know why it's considered this 11 million? Is because SARS gives, I mean, it taxes for capital gains, right? It does tax capital gains, right? So you know that this amount, there's a possibility for it to appear even in the tax side, because tax also taxes it. Even though it's at the end, you see that accounting realizes this um fair value gain now, but tax is going to realize that gain later when you're actually selling that asset. But how much of it is it going to realize? How much of it? So for now, the tax base of this thing is zero, right? So how is tax going to realize this thing, right? So we do agree that, so this is the difference, right? The difference is 11 million, right? But what is the temporary difference? Obviously, do you see that tax will only account for 80% of this amount, right? 80% of this amount. So what is the temporary difference? The temporary difference is on the 80%. That's the only thing that's temporary, because the other 20% is permanent. Like tax will never tax on the 20%, right? So what are you gonna do? You're gonna take this 11 million, right? Because that's the difference. This is the difference, right? 11 million multiplied by 80%. So let's do that calculation. So it's 11 million multiplied by 80%, right? So 11 million multiplied by 80%, that gives us that gives us an amount of that gives us an amount of 8.8 million, right? So I'm writing it in the incorrect column, so just remove this. Okay, so that gives us 8.8 so it's 8.8 million. 8.8 million. However, I have even the easiest way to do like deferred tax. If you want that recording, please just text me personally, so you'll see there one of the coordinators, Tembo, just text me and I will do that video for you and I'll send it via your email. So just text me with your name and email and I will do the deferred tax like video to show you how deferred tax is. Because I believe if you know deferred tax, you already have like around 30% of the test, because every time you have to account for deferred tax. And in some questions, they even give you like a question for deferred tax alone. So you know that in every exam paper, there's always deferred tax. So if you can get that one right every time, at least you have some marks banked already. Because deferred tax, they will always mark on a principal basis because it's an underlying standard. So they are not going to mark their amount straight, they're going to mark your logic, right, using the amounts. So even though maybe you're carrying amounts that you calculated, maybe you were wrong, but if the way you did deferred tax like it's right, they're going to give you the marks for the deferred tax. Or it won't be then the mark in full, but at least they'll give you something. So at least if you know how deferred tax works, you know, basically I would say 30% of the paper. Then we can move on. So now we are done basically with the warehouse facilities. We are done with oh yeah, we're not yet done the recording with recording it. So we haven't finished with the deferred tax. So what are you gonna do with the deferred tax? Don't forget to multiply it with multiply this then with 28%, and then this thing is positive, so it's going to be a deferred tax liability. So deferred tax liability. So the deferred tax liability balance is going to increase. Yeah, deferred tax liability. Yeah, so you're going to say deferred tax liability you debit, and then income tax, deferred tax liability you credit, and then income tax you debit. Yeah. Then let's continue on. So construction crane. So it says on 1 January 2021. So that's last year, right? Okay. Last year, Abacus entered into a lease agreement for the lease of a construction crane from Calculator Limited. The terms of the lease are as follows. So they gave us the fair value of, okay, now this is what, before we get on, so we know the perspective, we know who we are. Now they tell us that this is a lease, right? Very important. This is a lease. So we know what scope we're working with. What is the scope we're working with? We are working with IFRS, because this is a leases, IFRS 16, right? IFRS 16 lease treatment. So we who are we? We are the lessee. So IFRS 16 lessee treatment, right? IFRS 16 lessee treatment, right? Because we are the lessee, right? For leases, I suggest you use this framework. So I developed a framework for it. Let me raise this. Let me raise this. Okay, let me raise this. Okay. Okay. So, okay. Let me see. Is it the full one? Okay, yeah. So the first step is it a long-term lease or does it qualify for treatment according to IFRS 16 practical expedient? So the first thing you do is determine whether it qualifies for this practical expedient. Now, in some questions, they tell you that it qualifies as a practical expedient. But in some questions, you have to determine whether it does qualify for this practical expedient. So what is this practical expedient? So it's either they tell you in a question, or it's if you have a low value lease, so a lease of a low value, right? You will see it's leases maybe for laptops, those low values. The thing is, the standard doesn't really prescribe an amount for a low value. Um, I think that you should just use your own judgment. So so I'm not gonna give you like a benchmark in terms of like amount. Just look at the asset and look at the nature of the asset and see whether that asset, like that asset like look at the substance of that asset compared to the entity. So for the entity, like is it a low value lease or like a lease like of a normal value, and then the second rule is if it's a short-term lease, so lower than so if it's a lease, it doesn't matter what amount it is. If it's a lease, it doesn't matter what amount it is. So it can be like even a high value lease. If it's for less than 12 months, so it's not more than 12 months, right? Then you're gonna use the practical expedient. Then if you see that maybe this lease is not within 12 months, maybe it's in 2 years or something, 3 years or something, but you see that this lease is low value, then you still use a practical expedient. Then, or they tell you that use the practical expedient. And what is the practical expedient? That's where you're gonna use that equalization rule. So the straight lining rules for the lease. So you're just gonna use this step. So the first thing you're gonna calculate all of those lease payments that you're gonna incur for the whole term of the lease, add them up together, then divide them by the term of the lease, and then that's your expense that's the lease expense. Right? That's if they give you this practical expedient. Now let's look at the question and see whether this is a long-term lease or whether the practical expedient like works applies. I mean, then it says the lease terms. So the terms of the lease are as follows. So this is for the lease of a construction crane. Do you see? The first thing, a construction crane is not a low value asset. So we know that that rule for the low value asset is gone for the practical expedient, right? Now the only thing that you'll have to look at is whether this lease is long term or short term, right? So they tell us the terms of the lease are as follows. Fair value of the lease, so the cash selling price, it includes VAT. So that's the fair value of the asset. So fair value of the asset, I mean fair value of the asset, cash selling price, including VAT. Okay, they gave us the amount there on 1 January. So when the lease began, they give us the monthly installments, and they say they're paid in arrears. Arrears means at the end of the year, at the end of the period, I mean, including VAT. Then the lease term, do you see they say 6 years? So we know definitely that this is a long-term lease. So we can move on to this next slide. So step 6, it says if it's a long-term lease, what does it want? It says step 7, determine the rate implicit in the contract, right? Now, this is what the standard says, and I wanna. This is what the standard says. It says you firstly calculate the rate implicit in the contract. If you have information readily available to calculate that rate implicit in the contract, that's what the standard stipulates. If you have information readily available to calculate this rate implicit in the contract, then the entity must calculate the rate implicit in the contract. If you don't have the rate implicit, if you don't have like the ability to calculate the rate implicit in the contract, or in the like sometimes in the question they just give you the rate implicit in the contract, then you're just gonna use it. So this step you're gonna skip it because it's done for you, right? Then In some questions, they give the rate implicit in the lease and the incremental borrowing rate. Now I'll explain where the incremental borrowing rate ties into this. Like I said, the standard says if the rate implicit you have information available to calculate the rate implicit in the lease, then you calculate the rate implicit in the lease, right? Or then the standard says if you don't have that information, you use the incremental rate of borrowing of the lessee. So I hope you got that down. So use the incremental rate of the borrowing of borrowing for the lessee if you cannot determine the rate in place in the contract. But that's the key thing. If you cannot determine the rate in place in the contract, so if you're not given the rate in place in the contract, and if you cannot determine it, then you consider incremental rate of borrowing. Ne? Then let's continue. I told that Abacus has the option to terminate the agreement after 4 years. They will incur a cancellation penalty of 1.5 million if they terminate the agreement early. At the commencement of the lease, Abacus considers it likely that they will exercise the early termination option, right? And then you are told that there are no guarantee or unguaranteed result values at the end of the lease term. Okay, let's move on to the next page. And they say the asset will not become the property of the lessee at the end of the lease term. So they're just returning back the asset. And they tell us that the lease qualifies as an installment credit agreement for VAT purposes. Okay, that's just for the VAT. And then they tell us that SARS grants unapportioned allowances of 10% per annum on all buildings and all building equipment, and a deduction of lease payments excluding VAT, right? So we know with regards to lease payments, there's no really temporary difference for that. So we are just going to consider deferred tax for the building equipment. So the reason why there's no deferred tax here for the lease payments is because there's no difference. There's no temporary difference. There's no difference. The way accounting accounts for the lease is the way tax is going to account for that lease. Then so the first thing is determine the rate in place in the contract. Do you see that even in additional information, you are given that, okay, we are a VAT vendor and the incremental rate of borrowing, they tell us 13%, right? They gave us the incremental rate of borrowing. They said Abacus presents the right to use assets separately on the face of statement of financial position. Then, okay, you may assume 15%. Okay, the last 2 points are okay. That's general points. We can move on. So you can assume a VAT of 15% and normal income. So normal income tax rate of 28% and capital gains tax of 80%. Okay. So the first thing is, what's the first? It says determine the rate in place in the contract, right? Now, how do we determine the rate in place? What is the rate in place in the contract, and how do we determine it? Ne? So the rate in place in the contract, please have this down somewhere. So the rate implicit in the contract, this is very important. This rate is done firstly from the perspective of the lessor, not the lessee. Perspective of the lessor, ne? The lessor, the lessor, the lessor, ne? So it's from the perspective of the lessor. And what does it say? Let's firstly write down all of those inputs. So the first one is PV, and it says the PV is equals to the fair value of the asset at commencement date. So at the lease commencement date. So what's the fair value of that asset at commencement date, right? Plus initial direct costs. That's the present value. So plus direct initial costs incurred by who? The lessor, because it's from the lessor's perspective, right? So fair value of the asset that the lessor is what is given to the lessee, and plus the initial direct costs, right? That they were incurred by the lessor for this particular transaction. So for this particular transaction, that's the PV, and then the N is the most likely. So most likely years. So the most likely term. I mean, sorry, most likely term. Ne? That's the N. And then the I, okay, the I is the rate implicit in the lease. So that's what you want, the rate implicit in the lease. That's the I, rate implicit in the lease. And then the PMT, the payments, these are the payments that the lessor expects from the lessee, right? So the lessor expects from the lessee, that's the PMT, that's the payments that the lessor expects from the lessee. And then lastly, we have the future value. So the future value is what is it equals to? Is equals to the guaranteed and unguaranteed residual values. So it's equals to the guaranteed and unguaranteed residual values. Now, that's basically how you calculate the rate implicit in the contract for the lessor, right? Now, firstly, what did I say? It's either you're given the rate implicit in the lease, or you're going to be required to calculate it if you're given information enough to calculate it, or if you're not given enough information, you're just going to use the incremental rate of borrowing. So those in that question that went on and used the incremental rate of borrowing in this question, in the test, they were wrong, because you could determine the rate in place in the lease. That's why they gave you all of those inputs in the first place. So just explaining this thing again, the rate in place in the lease again, the calculation, and this is very important. This is the main concept they use for calculating the rate implicit. It's from the firstly perspective of the lessor. And what is the lessor saying? The lessor is saying, I am investing what? I am investing the future value of this asset. That's why the present value is the future value of the asset. So what is the lessor investing in this transaction between the lessee? He's investing an asset, right? Because investing is what you're taking out, right? Because is what you is investing what the asset, right? Is what he's putting into this contract. So he's putting in the fair value of the asset, right? Plus what? Plus the cost that he paid, like for this contract. So for this contract to be able to exist, that's what he invested. And if you can look at it properly, that's exactly what he invested. That's what he put into this contract, right? And what is he getting? Like, what is he getting out? He's getting out firstly what? The payments. That's why we use the payments that the lessee is going to pay. So for investing this asset at fair value and these costs, he's going to receive this payment, right? So sorry. So what you do is the present value obviously is going to be minus the fair value of the asset and minus the initial direct cost, because you are incurring those costs. He's incurring those costs. Then the PMT is receiving it, right? So it's positive, that amount, because he's receiving that amount, right, from that investment. And then the future value, as you can see, it says guaranteed and unguaranteed residual value. So what is this? So I will firstly explain the guaranteed result value. Guaranteed result value. Do you see that term guaranteed? The reason why they said it's guaranteed from who? The lessee. So sometimes, like not sometimes, in most cases, like in like real lease contracts, what happens is the lessee has to pay another payment on top of that, so on top of the lease payments at the end, as a residual value, and that's a residual guarantee. So which means what? Over and above the lease payments that the lessor is going to get, he's also gonna get that residual guarantee he was promised from the lessee, right? Or sometimes the lessee can just say, I'm gonna give you this residual value and buy this asset from you after I lease that asset. That's still a residual value, because you're expecting to get that amount back, and it is guaranteed because it is in the contract. So you're expecting to get it back, and it is in the contract, right? So what's going to happen? Let me give you an example. Let's say the residual value guarantee was maybe something like 5,000. You said 5,000, you want 5,000. And then what happens is the value of the asset at the end. So you said what you said you wanted 5,000 from the less, you are the lessor. You said you wanted 5,000 from the lessee at the end of the term, and the lessee can maybe keep the asset. Let's say now what happens is at the end of the year, the asset's real value is 3,000. What does it mean? It means that that extra 2,000 must be incurred by the lessee, right? That's why we say the residual value is guaranteed, because no matter what happens, whether that asset gets the value becomes lower or whatever, like that result value is guaranteed. So that result value is guaranteed. That's why. And then we move on to the unguaranteed portion. Now we said the future value is guaranteed result value, right? Which we expect from the what do you call it, the lessee. Then the next one is the unguaranteed result value, right? So let's think about it properly. I'm going to give you like another example. Let's say the lessee expects to give you maybe this 5,000, right? But this 5,000 is maybe just a balloon payment on top of that payment that he's been giving you, right? What happens is, if you can still take maybe that asset and sell it maybe to another like entity outside, maybe you predict that you're gonna sell it maybe for around maybe 2,000, maybe. You predict maybe you're gonna sell it for something like 2,000 maybe on the outside. That means that what you predict is, you predict that you're gonna receive a 5,000 guarantee from the lessee, right? And this 2,000 unguaranteed from outside parties, right? That's that's the future value. Then all of those inputs, obviously N is the most likely term. So most likely term according to who? The lessor. That's why every time it's important to know the perspective. Who are you? The lessor, right? Then that's how you determine the rate implicit in the lease. So what is the rate implicit in the lease? You look at it from the perspective of the lessor. The lessor is investing what? His asset, and he's also investing the initial direct cost for the period of the lease, right? In order to earn what? The lease payments and the unguaranteed or guaranteed result value. That's how you get the rate implicit in the lease, right? So let's go to this question and let's do this question. Yeah. So to determine the rate implicit in the lease, right? We are firstly going to start with the like I said, these inputs, write all of these inputs down, including the payer. So including the payer. So let's go to this. So we're going to this. So starting with the present value. So the present value is going to be what? Do you see they gave us the fair value of the asset on commencement date, right? But it includes VAT. So that's fair value excluding VAT. And then so it's that present value excluding VAT, right? And then we go to the next one, the N. Or they didn't give us the N. Okay, not yet, not the N. So monthly installments, the monthly installments is the PMT. So that's what the lessor expects from the lessee, right? You firstly just remove tax, and then that payment you put it as an input for PMT. So don't forget the PV is minus, right? Minus that amount. Why? Because we are investing that amount. We are looking at it from the lessor's perspective. The lessor is investing that amount, and then the PMT is supposed to be positive because the lessor is expecting to receive those payments, right? And then they tell us that the lease term is 6 years, right? Now, before we get to the 6 years, let's read further. It says Abacus has the option to terminate the agreement after 4 years. Now, and they will incur a penalty of 1.5 million, right? If they terminate the agreement, the agreement early at the commencement of the lease, right? Our cast considers it likely that they will exercise the early termination option, right? Do you see that? Honestly, for this question, honestly, I'm not really sure about one thing, and I'm gonna use this assumption as I go forward because they were not really specific, right? You remember I said the rate implicit in the lease, you are calculating it from the perspective of the lessor. So you're calculating it with information that the lessor has. So what I did, I just assumed, I assumed that the lessor does not know that Abacus wants to terminate that contract after 4 years. Because even though he did put in that option, if he's not told by Abacus, or if he doesn't know, like basically the way they borrow, like he won't really have an idea of whether they are going to use that termination option or not. So for the number of years, I used 6. So as if they didn't use the termination option, as if they didn't use the termination option. However, if the lessor knew about the termination option, that Abacus is going to terminate this thing, the N that you're going to use there is for 4 years, but don't forget N is 4 times 12, so it's even for 6 is 6 times 12. That's why I initially said write all of those inputs down. It's specifically for the pay year, because these installments are monthly installments, so the pay year is going to be 12. Don't forget to change your to adjust your financial calculator. While I was doing this question, I can assure you the reason why I spent a lot of time here was because of the calculator. I didn't put in the inputs that are right. I was busy putting in 4 or 6. That's why I'm like, use all of the inputs there, because it'll really be terrible if you get a low mark just because you didn't like put it correct in the calculator. Yeah. Then, like I said, they're gonna use that 4 years. Now we are using 6 because I assume that they don't know, right? And then they said they will incur a cancellation penalty of 1.5 million if they knew. So if the lesser, the calculator limited, so if they knew, if they knew what was going to happen, they were going to put that 1.5 million as their future value, because we are told that there are no guaranteed or unguaranteed resolve values. So there are no resolve values. However, if he knew about this cancellation penalty, he was going to put this 1.5 million as the cancellation penalty, right? Because what did we say? The future value is what the lessor expects to get, right? Yeah. Then we move on. We move on, right? So now we know that we have basically all the inputs, because we have the future value. The only thing that we don't have is the rate implicit, which is the I that we want. Then you just put that in the calculator, and then the amount you get is 23.58%. Okay, I ran it off to 2 decimal places. That was wrong. It had to be 4. So please round out to 4 decimal places. Or it's 14.55 if the lesser knew about so if the lesser knew about the so if the lesser knew about this information, it was going to be 14.55, because you're going to use that 48 and then 1.5 instead of 0 for the future value, and 72, right? So I'm assuming that the lesser doesn't know. Then what happens? We now have the rate implicit in the list. You see, we are done it to step 7. We have the rate implicit in the list. What can we do? We can calculate the lease liability. So the eighth step is calculate the lease liability. So lease liability, you also use input. So you're gonna say PV. Obviously, lease liability. What you want is the PV, right? Write all these inputs down. So the PV you don't know, the N you know. Now, when you're determining the lease liability, you are back to the lesser, not the lessers, I mean, the lessee's perspective. Don't forget, when you determine the rate in place in the lease from the lesser's perspective, Mare, when you're calculating the lease liability and the right of use, you are back to the lessee's perspective, right? So determine the lease liability. So what happens is we want the present value. The present value we don't have, right? The number of years we know it's 4. For the lessee, we know it's 4 because Abacus has this information. We are sure that Abacus has the information. So it's 4 times 12, which is 48, the N. And then for the I, we are going to use those rate implicits. So one of the rate implicit, depending on whether we are giving information or not, right? So you will see with the solution whether that was the case or not. Then the PMT. So the PMT is going to be the same. So because it's what we are paying, right? So what we are paying, just gonna take out the VAT. Then don't forget to take out the VAT. And because we are paying, it's going to be a minus, because we are the ones that are paying. And then the future. So the future value, the future value is going to be minus that 1.5 million, because we expect to also over and above pay that amount. Now, if they also gave us a guaranteed residual value, you are going to add it here, because why? We expect to pay the guaranteed residual value, but not unguaranteed. So for the lessee, you only put guaranteed residual value, right? Because that's what you promised the lessor. And then then you calculate your PV, right? Calculate your PV. Now remember that PV, that PV is for the lease liability. So last year, what did they do? They said lease liability, they credit with that amount that you got, right? Last year, because they got it last year. Don't forget. Then you move on, determine the right of use asset. Okay, the lessee didn't pay any additional cost. So if the lessee also paid additional costs, other than obviously the payments is going to pay and the future value, if he paid other costs like initial cost, the lessee, you're gonna, so what you're gonna do basically, the first thing you're gonna do, I get you have your lease liability here. When I say lease liability credit, then right of use, you debit. So after you get your lease liability credit, right of use, you debit with the same amount. And then what you're gonna do is you're gonna check further for other costs, right? For other costs that the lessee incurred for having that contract. So for maybe the legal fees, drafting that contract. So those initial costs you add, right? And there's also a list of those that are excluded. Look in your standard and check which ones are excluded, right? And then that's basically the right of use asset. But you'll see in most cases it will be the same as the lease liability. But I'm saying in most cases, right? I'm not saying in all cases. So in some cases, they'll give you an amount for this. And when you get that amount, what you do is simple. You just capitalize it to the lease by saying bank you credit and right of use asset you debit. So you don't debit that expense, you debit the right of use. So when they say capitalize an expense or something, when you're capitalizing something, you will not see it on the statements that because you capitalized it, you actually added it to something else. That's what it means, capitalize. Add it to um add this thing to something else, right? Even though this thing is like, for instance, for borrowing cost, even though this thing is interest, capitalize it to PPE. So increase PPE with this amount, not the interest amount. That's what capitalize means. So here, all of the amounts directly attributable to this, there's also a list in the standard if you want to see, but you will see those initial direct costs. You also capitalize to this right of use asset, right? And then so you have those general entries. So for this one specifically, there was no initial direct cost. So the only general entry you're gonna have for last year was right of use asset you debit and lease liability you credit, right? Then we move on. Now, like I said, in what standard is this thing? It's in IFRS 16. So we have to firstly think about the story of IFRS 16. Now we know that, okay, initially we first start by measuring the lease liability and right of use asset, but what do we do with them subsequently, right? What do we do with them after? We depreciate the right of use asset, right? Over what? The term of the lease, right? Over the term of the lease, or if we are giving if the term of the asset is lower than the term of the lease, you use the term of the asset, right? Then the lease liability, you're going to amortize, normal amortization, because don't forget the lease liability, you only use your input in the first place to calculate the lease liability. Whereas right of use asset, there are maybe some costs that you capitalize to the asset. So you're just going to take that total amount and calculate normal depreciation on it, like it's a normal like PPE asset, like, yeah. And then the amortized part, this lease liability, you're going to treat it like a normal loan. Normal loan. So normal finance cost before value payment, you have to record the finance cost first, like I said, and then record the payment, right? And then also for the depreciation, don't forget to record the depreciation for the right of use asset. I'm not really going to do that right now, but don't forget the depreciation for the right of use asset. And do not also forget that this question is asking you for an extract of the statement of financial position. So, and there's an event that happened last year. Do you see that you have a balance from last year? Don't forget to keep on adjusting that balance from last year to include also the depreciation for last year and the interest for last year and this year's. Then you do the general interest for the interest for this year's, right? And then what you do when you're done with all of this, right? When you're done with all of this, just aggregate all of the general entries. So add everything up. So everything for investment property, you're gonna have a line for investment property, and then, so what you're gonna do after the general entries, you're gonna write the on top. This is an extract of the financial statement, the statement of financial position of Abacus, right? And then you write those you list those things, right? So you start with maybe PPE on one. You put in all those amounts that you've been recording per journal entry for PPE, right? Don't forget that the land is included also in that balance for PPE to include that 7.5 million, right? And then not the 7.5 million, I mean, no, not the 7.5 million. Don't forget, they said only a third of it is used for PPE. So you're gonna take a third of that land, the third of that land that's used for PPE. The other 2/3 are used in conjunction with that investment property, right? Yeah. Then yeah, don't forget that for your balances, and then you just add even the rest, you just add the rest. And then don't forget the question says do not put the liability that loan, so do not put that loan, but they still want to see the lease liability and all the liabilities, but do not put that loan. Yeah. And then yeah, that's how that question, you should approach a question like that. And basically any question. So the most important thing is knowing basically what scope you are at, and whether the standard is a main standard and an underlying standard. You know that the main standard, you focus on it alone until you are done with it. Then an underlying standard you're going to use we want to use together with the main standard. Yeah. Yeah. And then yeah, that's it for me. Any questions? Okay. Please don't forget to send your email and name if you want this the recording for this particular video. And don't forget to also type if so text me if you want a deferred text video. So if you want a deferred text video, also type. Don't forget to put in your email, but that's if you want the recording, right? Otherwise, if you got enough information from this and you feel like you don't need the recording, then it's fine. Thank you. Have a good day.